Hi. It's interesting times right now with the economy kind of struggling to get back on its feet, as well as the Dow ever changing, and then also our upcoming presidential elections that are coming in November. And so from that perspective, we get a lot of interest from clients with respect to acquisitions and other business combinations. And it's certainly a very viable opportunity to grow the company externally as opposed to the typical organic internal ways of growth, but it can be somewhat tricky in terms of tax and tax considerations. So wanted to go over those and highlight those tax considerations from really the four main components of an acquisition that we deal with typically in Clifton Douglas. Also, you can find this information in a Journal of Accountancy publication that came out in their August 2012 edition entitled Prepare Before Purchasing, and that goes over again all of the tax-related implications and considerations from a very high level that a company should consider before they actually embark on an acquisition. So again, acquisitions are extraordinarily complex undertakings, but for our purposes here at Clifton Douglas and in terms of what we deal with in terms of tax, there are really four primary areas in terms of an acquisition that hold these certain tax considerations. One is due diligence, the second is integration, then also purchase accounting, and finally post-acquisition compliance. And again, they're all tricky areas surrounding tax in each of these four key areas. So with respect to the first one, with respect to due diligence, really our primary goal in dealing with a company in terms of their acquisition and due diligence is really to mitigate tax liabilities for them. And so from that perspective, you're really first starting in terms of looking at what type of acquisition you have. If you have a stock acquisition, there's really not that much in the way of opportunity to mitigate tax liabilities from the standpoint that if in terms of a stock acquisition, the acquiring company typically assumes all the liabilities of the target company. So there's just not that much flexibility. But if you are dealing with an asset acquisition, then there are opportunities to mitigate tax liabilities. And from a tax perspective, you really need to start that focus, that mitigation early on, because it takes a lot of time, or it can take a lot of time, to identify what those tax liabilities are and then to quantify those tax liabilities, especially from the standpoint you're dealing with target company data, and this target company may have gone through various acquisitions itself. So from the standpoint that you've got to go through old files related to the target company and also companies that they previously acquired, it can be quite a reconciliation exercise. But typically what you find is with respect to like their FIN 48 reserves, those types of things. If you look at those and see whether or not the acquiring company or the target company has in fact done a thorough analysis. Maybe there are some lurking tax liabilities within the FIN 48 reserves if they haven't properly supported out their FIN 48 reserves, those types of things. Also, all their deferred inventory that you're bringing over, making sure that all of that information, that all of those tax attributes are in fact good tax attributes, and that you can reconcile them, back to the old returns and the old provisions, and that they're good, that they've been carried forward and with a legal underpinning is really important. So all of these aspects in terms of digging, in terms of really looking at what those potential liabilities could be if in fact again some of the tax attributes aren't good. I mean, that could raise a liability question. If the FIN 48 reserves are problematic, again you could have some tax liabilities rear their head. Also with respect to ongoing audits, if you have a situation where the target company is currently in an audit and that audit may not complete by by the time that the acquisition is finalized, then you have a situation in which case you really need to address the issue with the target company and come to terms in terms of who is going to handle whatever liability comes out of that audit if in fact the target corporation does not prevail. So again, due diligence is really the time to start early in terms of, if you've got an asset acquisition, to really start looking at what those tax liabilities are, identifying them, quantifying them, and figuring out ways to mitigate them. The second big area, at least from a tax consideration standpoint in terms of acquisitions, is really integration. And by integration, again, I think the tendency for a lot of companies is really just to look at integration from a tax department perspective, or at least from the tax department, they tend to look at integration from their own perspective, from their own tax department perspective. But realistically, the tax-related implications of integration are going to relate to many different departments of a company. So you have to look beyond the tax department as part of the overall integration process to make sure that in fact the acquisition is being completed, or at least from a favorable tax standpoint. And there are many departments that could be involved from a tax perspective, but we primarily see departments like, for example, human resources that are very involved from a tax perspective in terms of acquisitions, because the human resources department really takes care of payroll, and that payroll can be adjusted significantly upon an acquisition, such that it may require or create a filing requirement in certain jurisdictions where a previous filing requirement didn't exist, or it may eliminate a filing requirement in various jurisdictions. There also may be certain planning strategies surrounding where payroll should be situated post-acquisition that you need to deal with the Human Resources Department on that. So again, Human Resources from a tax perspective is a department that you definitely need to tap into in order to, again, really create a favorable tax structure post-acquisition, and also, from a compliance perspective, making sure that you're meeting all of your tax compliance requirements. Also, another department is similarly legal. Again, post-acquisition, most companies want to have the most favorable tax structure that they possibly can, and so they're really going to need to involve legal and get the assistance of legal in determining the best, most favorable tax organizational structure post-acquisition. So again, got to reach out to that department as well. It's very important. Then also with respect to just information technology, and the typical understanding is that, okay, well, we've got to integrate the systems of both the target corporation with the acquiring corporation, and that's true, that's really important. But also it's very important for the information technology group to be involved from the beginning to ensure that all the target company data is preserved and that it is understood from the standpoint of how the acquiring company deals with that target company data post-acquisition, so that they can access that data when they need it post-acquisition. It's really important to get the information technology department involved in this, because it's highly likely that target information will be needed post-acquisition. Also, thirdly, the third real big component from a tax perspective related to an acquisition is with respect to purchase accounting. And purchase accounting again, with acquisitions is extraordinarily complex. But there's one particular area that pops up and I think sometimes takes companies unaware, and it really has to do with a lot of changes with respect to the accounting pronouncements surrounding business combinations. It used to be that most aspects of a business combination were in fact accounted for as part of purchase accounting under FAS 141. Then FAS 141R came out, a revised version, and of course it was codified as ASC 805. But from that perspective, those changes no longer was everything taken care of as part of purchase accounting in terms of an acquisition or business combination. Now you had certain situations, certain circumstances in which case actually the accounting would occur outside of purchase accounting and would in fact hit the financial statements of the acquiring company, would impact tax expense, would affect earnings volatility. You see a lot of this with respect to the acquisition of deferred tax assets and related valuation allowance release. You also see this with respect to acquiring unrecognized tax benefits and then their impact post-acquisition. So once again, the big takeaway here is to ensure that you understand that there are some situations and some aspects of purchase accounting in which case the accounting impacts will not be taken care of as directly part of purchase accounting, but because of changes in the accounting rules related to business combinations will in fact be addressed outside of purchase accounting, can impact financial statements, can impact tax expense, and can lead to potentially earnings volatility. So it's a very important concern relating to purchase accounting. The fourth really significant area from a tax perspective in terms of acquisitions is really with respect to this post-acquisition compliance. And for a lot of companies, post-acquisition compliance seems like kind of a give me, an obvious area. Well, we've got to put together our short period provisions, we file all of our short period returns, pretty much end of story. And it's true, it is pretty obvious, but I think a lot of companies are taken unawares in terms of the time and the preparation that it takes to make sure that all that post-compliance happens correctly. Right off the bat, there are going to be, or oftentimes, there are a lot of tax service providers involved. And so it's really imperative that the acquiring company determine which of those tax service providers are going to be doing the short period compliance, so that you don't run into a situation in which case, the acquisition's complete and now you're running back to the party that previously prepared the target company's information. It may be difficult to get the information and it's very burdensome. And if you do run into the unfortunate situation where you can't get that target company information and the acquiring company has to recreate all this data to file those short period returns, to prepare the short period provisions, that can be just an enormous undertaking, and it's just completely poor from a cost-benefit perspective. It just costs a lot of time, a lot of resources, potentially a lot of money. So it's really important right off the bat to understand who is going to be doing that post-acquisition compliance. Go ahead and assign that individual or that team of people and go ahead and get it taken care of. Also, making sure that you have time to roll in the results from due diligence is really critical as well, because again, you could have certain liabilities, certain reserves, certain deferred tax assets that may, change or may actually fall off the returns. Those types of things are the tax provisions. So again, rolling in the results of the due diligence will really have or may have a very big impact on those short period provisions, short period returns. Also making sure that the short period provisions and the short period returns take into account the acquisition specific related rules, and the primary one is really 382, 383 in terms of a change of control, because when you're dealing with an acquisition, you have a complete change of control when the acquiring company acquires the target company. So from that perspective, that triggers potential 382, 383 tax attribute limitations, and it may be that the utilization of various tax attributes like net operating losses and R&D credits and so forth may be limited. So really need to know that for that short period compliance. Also, with respect to transactions, related deductions, those types of things, you really want to roll those into the short period returns and provision to, of course, get those benefits. And then also things like parachute payments, 280G that come into play. All of these very specific acquisition-specific type of issues need to be prepared for and need to be rolled into those short period provisions and returns. So again, acquisitions are just a great way to grow strategically in times of uncertainty. But you need to be wary with respect to the tax considerations, and definitely plan early in terms of due diligence, in terms of integration, in terms of purchase accounting, and then finally in terms of post-acquisition compliance. And all of this is spelled out very well in our Journal of Accountancy article that was published in the August 2012 edition of the Journal of Accountancy, entitled Prepare Before Purchasing. If you have any further questions with respect to the tax implications and considerations surrounding an acquisition or other business combinations, then please visit us at cliftondouglas.com, or you can give us a call. Thank you so much for watching today, and have a great day.